Hello everyone, this is Richard K from Price Action and Income, and today I prepared a short video on a very familiar indicator called the MACD, which stands for Moving Average Convergence Divergence. First I want to talk to you guys about the variables that make up the MACD, then we will look at how the MACD is generally used to spot a condition called momentum divergence. And lastly, I would like to give you a glimpse of how I personally incorporate the MACD in my own trading strategy. Traders today rely heavily on indicators to assist them with their technical analysis, and the variables used to calculate an indicator's value are mostly based on the open, high, low, close, and volume of a candle or bar, depending on what you like to use on your chart. Now, these variables have led to the creation of thousands of indicators, but they all fall into four types or main categories, which all aim to achieve one particular goal. Firstly, we have trend indicators. Secondly, we have momentum indicators, which falls under today's topic. Thirdly, we have volatility indicators, and then lastly, we have volume indicators. Now, beginner traders often make the mistake in thinking that the more indicators they have, the better their results would be, but this is simply not the case. Using too many indicators or not knowing which indicators to use in combination with each other can cause sensory overload, confusion, and false signals. So before we start with the variables that make up the MACD, I just want to mention that it is important to understand that although an indicator can be a great analytical tool to assist you with making trading decisions, that they typically work much better when they are incorporated as part of a strategy that combines indicators with other analytical techniques. And that I will show you towards the middle of this video, so please stick around until the end. Okay, so which variables make up the MACD? This indicator consists of three main parts. And the first part is the standard MACD, which is on my chart colored in blue. And this line is calculated using the closing prices of a 12-day exponential moving average, or EMA for short, minus a 26-day EMA. The second part is the orange line on my chart, which is called a signal line, and it is calculated using a 9-day EMA that is plotted next to the MACD line, and it signals turns in the indicator. Then lastly, we have the third part, which is called the MACD Histogram, which shows the difference between the blue MACD line and the orange signal line, and it is plotted in green or red above or below a zero line. Your charting software might use different colors as a default, but today we will be sticking with my default colors using my charting package, in this case, TradingView. Now look what happens when the MACD line and the signal line cross each other. When the MACD is above the signal line, the MACD histograms plots above the center zero line, and vice versa when the lines cross each other the other way around. That, guys, is a quick overview of how the MACD is calculated and displays on a chart. Although this was a short explanation of the parts that make up this indicator, guys, and I know that a lot of newbie traders will have questions about which settings to use, etc. But just follow along as I go through my charts later and notice that I tend to simply use the standard settings. You can, however, experiment with changing those settings yourself, but as you will see later, the standard settings work perfectly well for me. Alright, so let's now move on to how MACDs are typically used to spot a condition called momentum divergence. So what is momentum divergence and why is it so important in technical analysis? Momentum of price movement can be defined as the force at which price is moving in any particular direction. The start of trends normally displays an increase in momentum, but as a trend matures or comes to an end, the momentum at which the price was moving tends to dry up before a change in direction occurs. To show you what I mean, let's use this section of price movement on the Euro-US dollar using a 4-hour time frame as our example. Now, as price started moving lower, you can see that the MACD histogram at the bottom panel here started off with a lot of momentum as the red histograms became larger and larger, in this case below the center zero line. Then from around the middle mark in this move lower, price kept moving lower, but this time around, the red histogram started showing a decrease in momentum as they became shorter and shorter, moving closer to the zero line again. This condition is what's referred to as momentum divergence, i.e. prices is moving in one direction, in our case, lower. Momentum first starts off with a lot of momentum as displayed by the histogram, but then it starts drying up and starts moving in the opposite direction as to what price is doing, in this case lower. I've marked up a few other places on my chart showing the same condition, which pops up over and over again. Like for example at this move lower, prices started with a lot of momentum. As price goes towards like the middle of this move, momentum starts drying up, makes a little lower high, and then starts moving lower again. In this scenario, there was some momentum divergence between this low and this low, but probably not as prevalent as the others. Let's look at another example. Look at this move lower over here. Price initially starts with a lot of momentum. Then we have this quite a strong drop lower, increasing in momentum. And as price moves between this pivot and that lower pivot over there, we have again divergence in our momentum or MACD. Here's another example. Price then moves up higher again. Initially, price starts with a lot of momentum going upwards, and as it goes into this peak, it's slightly diverged from what price is doing. And then as it goes into this high over here, we have quite a large drop in momentum. That in short was a quick demonstration of the MACD and momentum divergence. But please take note that there is one big problem with momentum divergence indicators though, and that is that they can show divergence from price action for a long period of time in a strong trending market, which can render this indicator almost useless when trying to determine the ends of very strong trends. It is therefore my opinion that the MACD should not be used on its own, but in combination with other tools to make better trading decisions. When used with other powerful analytical techniques, the MACD becomes very useful, especially when you start getting cautious about a possible trend reversal or spot the end of a correction. Okay, and this brings me to how I incorporate the MACD in my own trading. For those of you guys that follow my work, you will know that I use market geometry with multiple time frame analysis, various entry conditions, etc. But I also use only one indicator, yes, the MACD. On this chart, again, I used a 4-hour time frame, but this time on crude oil. And I want you to focus on this move lower that started on the 23rd of April this year. At first, price started breaking below previous levels that I was looking at, and this signaled a potential change in trend for crude. Now look how the MACD histogram started off with a lot of momentum, then suddenly it started slowing down into this low we see over here. After that bullish momentum divergence, I got a correction, which is something I always look for because I like using market geometry, in my case pitchforks, to try and spot where a correction might end before I try to jump into a trade in the direction of the main trend, in this case down. I have through the years studied corrective patterns in detail and found that they give clues as to which type of correction I might be dealing with in real time, guys, not after the fact. Armed with this knowledge, I then use my pitchforks to identify a level or a price zone where I assume such a correction might end. Now, corrections typically end at the upper or lower median lines, depending on which direction you are looking for a correction to end, or in extreme cases, at the upper or lower red warning lines of the same pitchfork. Now, on my chart, I drew my pitchfork after I identified a correction which I labeled as A, B, and C. In this case, price hit my upper blue median line on multiple occasions, but this is where the MACD becomes so useful. What happened to price when it reached the pitchfork line? Yes, momentum started slowing down, as I indicated on my lower panel on the indicator. What I also do with my own strategy is to switch to lower time frames and watch for momentum divergence there as well. and I have incorporated the MACD as one of my entry conditions to signal a possible change in a price's direction. Using the MACD in conjunction with my knowledge of corrections and using my pitchfork as a guide, I was able to pinpoint the end of this correction with precision. I also marked another area where a correction occurred, and I used my pitchfork again. You will see that the end of this correction again ended at the upper median line of my pitchfork on momentum divergence as indicated by my MACD histogram. In my second example, there was a much stronger divergence in momentum using a smaller time frame, which was much more prevalent than on my 4-hour chart. Let me show you that quickly. Here is that same correction we were looking at on the 4-hour chart, but this time I switched to a lower time frame, in my case a 30-minute. And as price came up, moved down, and moved up again, it ended right at my upper median line of my pitchfork. And this time, on a 30-minute chart, you'll see that I had huge divergence. Price initially started moving up with quite a lot of momentum, but as it reached sort of like this level over here and moving into my upper median line, price started moving, or momentum started deteriorating at a rapid pace, signaling a possible end of this correction, which got me short once again right at the top or the end of this correction. Okay guys, I hope that I've showed you some new ways to use your MACD and how well it can work if you incorporate it with other technical techniques. In my case, I used pitchforks, corrections, multiple time frame analysis, and special entry conditions that I need to see before I will enter into a trade at the end of corrections when I try to trade in the direction of the larger trend. If you guys are interested to find out more about how I trade, then be sure to watch my previous videos or read the description below. I would be really grateful if you can leave a like below and subscribe to my channel for some more insightful videos in the future. Until next time guys, this is Richard from Price Action and Income. Goodbye.